If you're watching this on YouTube, make sure you smash the like and subscribe buttons. If you're listening to our podcast, go leave us a 5-star review. All of our links can be found in the video description or show notes below. Hey, welcome back to the Average Joe Finances podcast. I'm your host, Mike Cavagioni, and today's guest is Tim Townsend. And Tim is calling us in here all the way from Australia, from the other side of the world, which is pretty awesome, which we've had recent guests from down under not too long ago. Tim, super excited to have you on the show and hear your story. Welcome.
Yeah, thanks, Mike. Really appreciate the opportunity.
Yeah, absolutely. Tim, let's go ahead and kick this off the same way we start every podcast episode. And me and my guests would love to know more about you. So if you could share a little bit about yourself, tell us your story. Who is Tim Townsend?
Wow. Where do you start with a question like that, Mike?
That's some question, right?
Yeah, you can go a long way back and talk about growing up on the Lighthouse in far northern Australia through my childhood to end up actually today running a wealth management practice for investors here in Melbourne, Australia. And we look after $400 to $500 million worth of assets on behalf of clients and have been doing that type of work over the last 35 years. And so that really brings us to our discussion, because I think being able to assist people, help people be better investors has been really at the core of our success as a practice, and possibly me personally, in how we've guided people.
Awesome. Yeah. So actually, let's go ahead and dig into that, because you piqued my interest, especially being a sailor, right? I was in the Navy for 20 years. What was it like growing up in a lighthouse?
Have you ever stood on Alcatraz in San Francisco Bay?
I have not, but I have been to
But
the
you
lighthouse.
know what I refer to.
Yes, I do.
Booby Island, and if you're going to be a pubescent young male growing up on an island, that's not a bad one to do it on. Up in the Torres Straits north of Australia is an island exactly the same size as Alcatraz. The only difference is that when you stand on it, there's nothing on the horizon. And so a number of years of my life I was there doing correspondence for education and stuff like that. 3 families lived on the island, but that was an interesting childhood. Some people say I talk more today to make up for lost opportunities then.
That's fair. I can understand. That seems pretty isolated. I know sometimes I live in Hawaii right now, and sometimes we can feel pretty isolated, but we have a lot of people on the island. To be stuck on a small island the size of Alcatraz and have 3 families on there, that's got to be pretty rough, especially as a child. Is that what made you get into the finance world?
I think to be frank with you, I think it certainly matured you quickly. You had to learn how to talk to adults. So as a child, you grew up very quickly, and then off to boarding school when I was 10 and things like that. I do see elements of what I do today and that engagement with people, because the financial planning engagement with people is very much, it's partly about money, but it's about helping people on a journey. The financial side is like an engine in a car. You want to be able to build an engine that's capable of driving the vehicle, but more importantly, you better be in the right vehicle that's right for you. And that requires a bit of thought, a bit of planning to be able to build that. You've got the financial side, the engine, and we can talk a bit about that today, but actually making sure it's driving you to the right place is a huge part of people's success in this space.
Yeah, 100%. Understanding. I think understanding the destination, what your end goal is, super important, because if you get in a vehicle and you just keep driving and driving, eventually you're going to hit the ocean, right?
Yeah.
And there's nowhere else to go. Even depending on where you live, you're going to hit a cliff, right? And the thing is, where do you go from there? And I think that's the question most people don't really prepare themselves for. And I like your analogy. I do like to talk stories when it comes to investing in your financial journey, right? Because I feel like it helps people relate to it a little bit more and help people understand that there are so many different ways to go about, bringing financial literacy or building your wealth than just doing any traditional method. But at the same time, there are many methods that are very important. And sorry, I'm getting a little distracted because my cat is in here scratching at my jeans. Sorry about that. If you guys hear any background noise,
we
he's
knew
not supposed
it would
to be
be
in
back.
here. I have an infiltration in the studio. The cat's on their own journey right now too. So that all things being said, go to the litter box, get out of here. Anyway, I like hearing things like that because it helps you better understand it, right? And so I'd like to talk about that when it comes to the different vehicles, especially with wealth management. I know that you see all different kinds of vehicles that your clientele probably use to get themselves to a point where they're going to be able to retire one day, right? So what are some of the methods that you've seen that have been successful?
Look, there's a range. All of the options that are available to us as investors and so forth are simply tools in the toolbox. I hear people say things, oh, I do stocks, or I do property, or I do this, or I do that. And I go, so are you a slave to the investment, or are you making the investment work for you? Because all of them have application in different ways to build a portfolio.
Yeah.
And it is about building portfolio. There's a process that sits behind this. There's a discipline. A wonderful quote from Warren Buffett that we have a habit of quoting, but I particularly like this one. And I think it goes to the essence of what I see makes successful investors. To invest successfully over a lifetime does not require, and this is very reassuring to me, Mike, a stratospheric IQ, unusual business insight, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotion from eroding that framework. Now, in those words is the essence of what we talk about as successful investors. It's actually having a plan. It's determining a structure. It's actually implementing that with a level of discipline and being able to hold on through the bad times for the good. Because we see this happen time after. We saw it happen recently in COVID. What actually happened in COVID is that many people rang up their investment options, their investment houses, and when markets had fallen dramatically, 30, 40% went to cash. And the reason they went to cash is because they never truly understood the essence of what they were doing, only to see governments around the world pour huge amounts of money in for markets to recover. And those people had immediately wiped out possibly a third to 50% to a half of their life savings and probably never to get it back. Now, why does that happen? Because they hadn't accepted the inevitability of those times. I think our belief comes back to a fundamental system that do we believe that asset-based markets in general will outperform renting our money to the bank? Well, it better, because otherwise when we rent our money to the bank, who are they going to be lending it to? Because if you don't believe that by owning good quality stuff, let me get highly technical here for you for a moment, Mike. By owning high quality stuff and a diverse range of it, you would always expect over time that to outperform renting your money to the bank. Those are key belief systems that people need to be comfortable with to be successful investors.
There was something you had said earlier. I wrote this down when you were quoting Warren Buffett. Staying disciplined is one thing, but keeping the emotions out. And I think that's one of the things that people probably struggle with the most, and probably why you see events that happen like you described during COVID, and even what happened back in 2008. You look at the state of the market, you look what's happening, and immediately you feel this dread and you feel this anxiety, and you're like, oh my goodness, I have to sell. I have to get out right now before it gets any worse. And every single one of those scenarios, if they would have just left everything alone and stayed disciplined and stayed focused on what their end goal is, what their destination is, they would have come out even stronger than they did previously. I have a friend of the family who describes to me what they did during the 2008 crash.
Yeah.
They said, you know what? I'm leaving everything alone. I'm not touching anything. I'm not selling. I'm not moving anything. They left it alone. They came back over the next couple of years much more wealthier than they were if they would have sold during that time frame and then had to buy back in. If you're going to sell that low, you're selling at a loss. And when you come back in because you see the market starting to trend up, you already missed the bus. So if you would have just left it alone, you would have been fine. That's the thing. Like if you look at the history of the market it's always bounced back. It's always recovered. And it doesn't
Yeah.
take that long. It doesn't
That
take that
doesn't
long to
mean that
recover.
doesn't mean at the same time, Mike, that everything recovers. There's
Sure.
nothing
There are
wrong with
companies that go
viewing what,
bankrupt. That happens.
yeah, things
But
there will be things that break in every portfolio.
100%.
The key is not being overly exposed to one.
Mhm.
That's number one. And number two is actually having that discipline not to fall into the worst trap of all, which is selling good quality things when they're cheap and buying them when they're expensive. But here's the interesting point about it is that we are set up as human beings for that. It's fear and greed. Oh,
Yes,
gee, everyone's making money. I
100%.
better go and buy some. And then, of course, there's fear. Oh my gosh, everything's just fallen in a hole. I got to get out.
Yep.
These are the natural traits that we as human beings have. And yet that's counterintuitive to your financial future. It's developing sufficient understanding. Personally, I remember I can go right back to 1994 when the bond crash occurred. That's where interest rates go up very quickly and government bonds deliver negative returns during that period. And it was the first time investing with clients that I found that they actually had a negative return. Now, it was only -8%. We've been through a lot worse since.
Oh,
But it
yeah.
was the first time where I actually had clients come in and point at me and say, "What have you done to me?" And I'm sitting there going, hey, they didn't ring me to see whether the market could go down. But what I had a realization of is how poorly I'd educated those people to the decision they were making, how poorly I had educated them to have the tolerance of volatility. Because volatility can become your friend. It creates buying opportunities when you can buy good stuff when it's cheap, and then down the track, take profit when it's expensive.
That's a perfect way to put it as well. I feel like this is part of the reason why I have this podcast as well is, financial literacy is not something that's just
No,
brazenly taught in school. It's not something when you go to college, yeah, you can go take economics classes and you could take different financial classes in college. You don't get taught this stuff in high school or anything else like that. I look at the decisions that people make based off of their emotions and based off of the limited knowledge they might have because they didn't learn about these things. They don't realize the decision that they're making could be detrimental to them in the future. And your realization that you came to in 94 when the bond market was negative, I feel like that's a testament to that this is a problem and it's been a problem for a long time. Right? It's
absolutely.
been a problem for a very long time. So, Tim, I want to ask you then, what is your take on, or actually, how do you educate your clients now to help them understand volatility and be more tolerant of it? Because that is one of the things you do have to be tolerant of and understand that it's going to happen. You can be in the safest investment, but there's going to be volatility no matter what. Every investment comes with risk, and people need to understand that. So how do you portray that message to where it's digestible and people say, okay, you know what? I get it. I understand that this is going to happen and I got to stay the course.
I was intrigued when you mentioned before about storytelling because I find it's one of the most powerful forms of communication. Since we were all living in caves sitting around fireplaces, we were telling stories, and it's the same here. But it's also the reality check. To be frank with you, the education is quite brutal, quite brutal. And what I mean by that is we have clients that I've worked with since the early 2000s, and we can track year on year the performance of their portfolio. Now, if you track the performance of the portfolio, standing out are the years that you were speaking of just before when the global financial crisis occurred. You have 2 years. Now, the first year, and I just say to people, I say, I want you to imagine before you invest any money, I want you to imagine we've been working together for a while. And here's the numbers right here on the board. There, you can see them. But have a look at 2008, -22%. And so what I then do is I say, now have a look at the next year, because I want you to imagine you've now come in 12 months later. You were brave. You held the line. We stuck together. You're still invested. You come in a year later, I say, good news. Not nearly as bad as last year. It's only another -20%. Now, let's just apply this for a moment. I want you to understand what that feels like. And let's assume that they're investing an amount of money. All I do is I look at that amount of money and I take off 22% and I tell them what it's worth. I then take off another 20% and I tell them what it's worth. And I say, right there, if you sell that portfolio, that's what you're going to get. But then you can go back and look, just as your friend was able to hold the line, had the courage and the discipline, and it does take courage at times, to hold the line, and they recovered. Now, if you actually look at those numbers, they actually add up to a return of inflation plus 5.5%. And for most good investments over time, a return of inflation plus 3, 4, 5% is actually a good rate of return. And so understanding what the pass mark is a big part of it, accepting the bumps in the road ahead of time, and actually doing it on your numbers. You know, anyone that's thinking as a diversified investor, look at your money, minus 22%, minus 20%, look at that number and sear it in your brain. Because if you think that couldn't happen, you're wrong. If you think it's the end of the world if it does happen, you're wrong, unless you're a forced seller. And you see, that's a really interesting thing, is that the mistake I see people make time after time is they set themselves up so that they haven't set aside sufficient amounts of money to cover their income needs. And what I mean by that, we use a concept we call circumstance and attitude. We look at someone's circumstances, and if you tell me, look, I need out of my investments $50,000 a year, so I'd say terrific. Then let's put $200,000 to $250,000 of your investable assets in defensive, a place where the capital is relatively secure, and try and do better than cash. The balance of your portfolio, based on your circumstance, could be invested in growth volatile assets. And what we then do is we take the income from the growth assets and keep refreshing the defensive element. But in those circumstances, that individual can survive a 6-7 year downturn in markets and never, ever be a forced seller of quality assets when they're cheap. Now, at the same time, you also need to engage in a discussion about people's attitude, because that may well be fine that I'm correct in that statement and that system works. But if you're going to panic, if that's your mindset, we need to identify that and either pull back further or educate you sufficiently to be tolerant.
I think that's huge, Tim, because as you were describing that, I'm thinking to myself, you can set yourself up in a way where you're going to be safe. And if there is that downturn, you've got that safety net. But at the same time, your attitude's still going to matter, right? Because even if that downturn happens and you know that you have that safety net, you still have to have the discipline to stay the course. You still need to be able to maintain and still continue the way that you were going prior to any type of downturn or anything else, and understand that it is going to bounce back and you just have to be vigilant. And I feel like that's,
Mike, interestingly enough, the day it doesn't, I mean, forever, the game's over.
yeah.
The whole economic system that we rely upon has been, and that can happen. You go back to European countries during the Second World War, you go back to where you've got those extreme events that can destroy an economic environment. But if we can hold it together sufficiently with all the challenges that we face, the economic environment constantly has to reward those that are willing to take the chance, those that are willing to have a go. Even though, and you pointed this out quite correctly, Mike, the system doesn't educate. The system educates you to work for money. It does not educate you in how to make money work for you.
Yep.
The game we're all in, you actually used a word I use less and less these days, Mike. You used the word retirement.
Yeah.
Now, I've replaced that with financial independence. What that
That's
means is
fair.
that's the day you go to work because you want to,
Yeah.
not because you have to.
You know what? I love that because that's where I'm at in life right now too. I did retire from my first career and I got
That
myself.
was, that was Navy, wasn't it?
Yeah,
Well,
yeah. And I got
yeah,
myself to the point where between my pension and my other investments, I have enough income coming in that I could sustain if I didn't work, right?
yeah,
Now I go to work because I want to. And the whole thing, the whole reason why I do it now is I'm trying to build even more for my kids, right? I'm trying to
sure.
make sure that they're taken care of. And I'm actually working on a second pension right now anyway, which I only have to do a couple of years to get. It's nice to be in a situation like that, right? But it also took a lot of grit and hard work to get there. And I feel I started late too. And that's why I try to
Yeah.
tell people like it's never too late to really if you focus and what your goals are and what you're trying to do and you have a set number, you can focus on that and get there. I did it through real estate. There are different ways, there are different vehicles, as you had stated earlier. There are different vehicles to get you to that end destination. And you just got to figure out which is the right one for you.
And it's worth talking a little bit about that.
It's
One of the
not
great
just real
things,
estate that I'm in. I'm just saying that
no,
that
no,
doesn't
I
mean,
appreciate that. But
yeah,
there are people that go out and go, I'm going to do it through real estate. And one of the attributes of the real estate, one of the greatest drivers is our willingness to borrow. People will borrow huge amounts of money against real estate that they would never contemplate about investing in stocks and things of that nature.
guilty with my
Well,
HELOC. Absolutely.
well, let me tell you a
To
brief
buy
story.
more real estate.
I understand the stock market
Yeah.
very well, having spent years and years investing in investing in everything. But I personally, my wife and I own a property in Queensland here in Australia. I own a couple of properties. Now, why do we actually own that property? Is because if I had gone to my wife and said, we're going to borrow that amount of money to invest in the markets, she would never, ever have slept at night. She was intolerant of that. So remember, we talked about attitude, right? So we
Yeah.
ended up buying a property which will actually get sold next year as we move on with our plans in certain things. The property has not earned anywhere near as much as I could have in an alternative approach, but the leverage in it has made it a higher returning opportunity for what we put in. So the one thing that property brings is our willingness to leverage, which is fine. Nothing wrong with that. It's just understanding the characteristics. Remember, the tools are never evil. The tools are never wrong. It's how you use the tools that's actually the important issue. But why do I pursue diversification? Because I trust nothing. I believe in nothing as a certainty. And that's taken years for me to understand that and accept it. What I believe in is the clients I represent and actually ensuring they have a deeper understanding of some of this stuff.
Yeah.
And we'll talk in a moment about maybe it's worth talking about, hang on, what are the steps to get myself in order? So we'll come back on that particular issue.
Actually, so something I wanted to touch on, Tim, before we get into that is I wrote this down because you had mentioned this earlier, and I don't think a lot of people think about it this way too much. You had mentioned about having that a sustainable return is matching inflation plus 3 to 6%, right?
Yeah.
And
Yeah.
a lot of times people look at, oh, I've had a 12% return on my investment this year. Okay, that's great, but inflation was 9%, right?
Yeah.
So you really got a 4% return. So you need to understand how the money that you put into the market, what the true value of it is when you put it in versus when you take it out, right? Because there is value lost due to inflation. So as long as you are keeping up and beating inflation, you're in a pretty good spot. But if inflation's 9% and you're getting an 8% return on your money, yeah, sure, your money's growing, but the value, what it's going to be worth when you go to withdraw it, when you hit that financial independence time, it's going to be worth less. You were not really at keeping up. I think that's an important way to look at it, Tim. And I really appreciate you bringing that up, that you really want to look at what is the inflation number as well and subtract that from your rate of return.
I tell you what I saw that really stood out to me. I remember the late 80s, early 90s. I was working in a credit union, savings and loan type organization here in Australia. And interest rates had got to 18, 19%. Could you imagine if interest rates went back to those levels as we saw back then right now, especially with the level of debt that people carry.
Oh, it
But
would be
18,
devastating.
19%. And I've got a poster at home because it struck me at the time how unique it was. And we were offering a 3-month term, what we call a term deposit, I think CD in the US quite often, a 3-month investment, just cash, paying 18%. 18%. You got not 18% per annum, so just 3 months of that, but 18% was the rate of return. But the interesting point was this: most people that were putting money in there were on the top marginal tax rate. And so on the 18% they were earning, they were almost giving half of it away in tax. So your 18 becomes 9. And inflation at the time was running at 10. They were losing 1% per year in the value of their dollars. And so it was a really case in point of seeing in real time the impact of that, of ignoring inflation in your calculation and ignoring tax. Yeah. What I care about is what goes in the pocket of my clients every year in real dollars.
I think that's the thing, is realizing what those real dollars are after those deductions that have to happen, especially the unseen one, which is inflation. Because taxes, we see that. Like when we have to pay it, it's a visual thing. We know how much we're paying. It sucks. And you pay those taxes and it's gone. Inflation is the invisible killer because you don't see that. That's the one that sneaks up on you like a ninja and gets you. So you got to be careful. And I think I really appreciate that you bring up that perspective because not a lot of people talk about that. Not a lot of people talk about the silent killer of inflation. Yeah, I appreciate that.
You work hard for your money. It's right to ask your money to work hard for you.
100%. And that example that you gave too, right there was killer, especially if you're looking at your top earners were investing and inflation was, 10% and they were really getting a 9% return. They didn't realize their money wasn't working for them. Their money was just on vacation.
But I remember how happy they were. They thought they were rich in a bit.
So I know that there was something else, another thing you wanted to talk about. So I'd like to.
Well,
it
struck me one thing that might help people to just focus on this. And look, some people will find the space to go and get advice, get a coach, get a finance coach. Obviously, fundamentally, that's what we do. Many people can't afford to do that. And so maybe I just thought we might just talk briefly, Mike, about just the journey. What are the steps of the journey that you can even do yourself to really focus on? And the first one is really building a summary of where you actually are now. It's the plan on a page. It's find, okay, this is the income I'm working with. These are the assets I've got behind me. This is what I've got in my 401k. All of those things, superannuation as we call it in Australia. Figure those things out. Get it down on a page and understand your position today. And then either with each other, if it's a couple, or something we do time after time, we do a thing we call 10-3 now. It's about understanding where somebody is now and actually saying, where do you want to be 10 years from now? Where do you want to be living? How often do you want to be working? All of those things, because you can actually understand the financial impact of that. And then once you've got those two elements in place, you start to say, what do I need to have done within the next 3 years to be on the journey to that outcome? What do I need to change? What do I need to implement? What do I need to address? And I think if you've actually done that, you might start putting more money into your 401k. You might be putting more money into investments. You might decide to go and leverage an investment, possibly through real estate. But again, it's actually being methodical and thought out in how you're doing that. Now, maybe I'm spruiking my own book here because we do that all day, every day with clients. But the point being is you then need to be able to stick to the journey. So I think if you think about that, it's where you are now, where do you actually want to be, and then you can focus on how to get there. That seems simple, but in many ways, it's creating order out of chaos. And we're living in a world right now where it feels more chaotic every day. And the danger is that we get so caught up in the noise you move away from that fundamental belief that a diverse range of good quality, I'm going to go technical again, Mike, stuff, good quality stuff will deliver a rate of return. And what I've witnessed time after time is we end up fixating on what we can measure. So we can measure fees, we can measure a return. You can't measure risk effectively. We have measures in the profession, but quite frankly, I don't think any of them really work that effectively. And so what actually, we fixate on what we can, oh no, this option is more expensive, so it's got to be bad. Not necessarily. It's what you're going to get from it that counts. If I could find a way to double the cost of all investing that I do for clients and triple the return, I would take that every day of the week.
Yeah.
Don't get caught up in what you can measure. It's about actually sitting back. Do you believe that diverse range of good quality assets will work? Always put your position in a position where you've managed your cash flow so you're never a forced seller, either through cash flow needs or fear. Replace the word fear with ignorance, and make sure that you understand where your car's pointing. And whether you put a 4-cylinder engine in it, an electric motor, what, it doesn't matter. But the point being is understand the vehicle you need. And sorry, can I add one more thing to that?
Absolutely.
Because what actually happens out there very often is we come across people that offer us advice who are just trying to sell us something. Good advice only works for one person. It works for the person who's taking the advice. That person, you need to align your interests, because if they're working for the house, they're normally trying to sell you something from the house. And that's okay, as long as they put you in the right vehicle for your needs. If you take a couple who go down to the car dealer and they say, look, we live on a farm, we carry hay bales. And the car salesman says, I've got this lovely little 2-door sports car because they happen to be overstocked this month and need to get rid of them. You're never going to have a successful outcome. So actually, but at the same time, does it matter whether that's a Ford or a GMH or whatever? It's not dramatic. So the point I'm making, it's about being in the right vehicle that suits you.
Yeah, Tim, I think that's a great point too, because in a situation like that, I think it's also the understanding of what is the right vehicle for you. So like that example that you gave, right? Yeah. You're not going to be dragging hay barrels around in a sports car. You understand you probably need a pickup truck, right? So
Yeah.
I think understanding the right vehicle for yourself is super important. And I think it all starts with asking yourself the question, the very first question you need to ask yourself that you had mentioned as well is, where are you now? And like you said, that's a comprehensive review of where you actually are, like looking at your bank statements. That could be a scary thing for some people when they actually open up their bank statements and look at what they've been spending their money on and say, whoa, we really got to take a look at what we're doing here. So I think having some type of financial plan in place is super important for you to get that, to answer that first question, right? To figure out where you are now. You have to be able to put everything in front of yourself, everything, put it all on the table and figure it out, right? That's the only way you're going to get to question number 2, to figure out where do you want to be? Because I don't think you could even answer that question if you don't know where you are right now, right?
Yep.
And then after you've got that question answered, then it's okay, how do I get there? You figured out, I know I want this destination. This is where I want to be. I want this to be the age that I'm financially independent. How do I get there? And that's when you go to someone like Tim here and say, hey, I've got this put together. I want to go here. Help me get there. I think that's super important. And I feel like you said, a lot of times people can't afford to just go to a financial coach or a financial advisor or anything like that. A lot of times they're going to turn to something like a podcast. We might have people listening to this episode right now that say, hey, maybe these are the questions I need to ask myself. Maybe this is something I need to look at right now for myself. And hopefully this lights a fire for some people. So I think it's really important that those questions get asked. So I really appreciate you bringing those up, Tim.
No, I think that's very well said, Mike. And I think like podcasts like what you're doing here And actually spreading the word and getting people focused is such an important part of it. Again, you come back to this issue. Stop spending your life working for money. And the only way to do that is to figure out how to make money work for you.
100%. Turn those dollars into your employees. All right, Tim, this has been fantastic. Definitely a lot of great information, a lot of golden nuggets. I got some great notes just from this chat that we had. I'd like to now transition this into something I call the final round. It's where I'm going to ask you the same four questions I ask everybody that comes on the show. It's a little bit more personal into you when it comes to some of the decisions you've made in your life and helps us get into the brain of Tim Townsend. So if you're ready to go, we'll.
A scary place, Mike, but
No.
let's have a go.
It's not that bad. All right, Tim. So first question of the final round for you is, what's the biggest mistake you've ever made when it comes to your finances or business life?
Ooh. I think in my case, it was I spent too long working for other people. Now, what I mean by that is that you learn an awful lot in that environment, and you can take all those lessons. But I didn't start my own business until I was 55. So around about 10, 12 years ago, I started this practice at that point in time. I wish I had done that earlier because of the freedom that it brought for me. But I think more importantly, did I know enough to do it? Maybe not. I always remember someone paid me a great compliment many years ago. They said, "You're the most employed person I've ever met."
I love that. That's awesome. All right, Tim, I love that answer. So this next question, you can see these kind of tie into each other. What is something that you've learned that you wish you knew when you first started?
Wow. It's an interesting point because the journey itself is part of the routine. In other words, I'm learning every day now. It's an ongoing process. So it's a passionate commitment to always believing I haven't got the answers, but they're out there somewhere. I think actually keeps you younger. I think it keeps you more focused and energized about the journey that we're all on, because it is just a journey. We know what the ending looks like. But the point being is that it's enjoying the journey along the way and each one of the experiences as well. So do I go back and look at something that I wish I could take back to the young Tim and give to them? I think it's actually a little bit more courage and belief in myself to get on with it and not fall for the trappings of new titles and opportunities and get caught up too long. I think that would have been helpful for me to do that. The courage to back myself, but to put a plan in place to make it work.
Yeah, 100%. I love that. All right. The next question, Tim, do you have any tips or tricks that you would recommend to someone that is just getting started today?
It's the discipline of regular savings. If you're making $1 and you're spending it, you are a victim to the journey. If you're making $1 and you send 20 to 30 cents on ahead, I can almost guarantee you financial independence. If you develop that level of discipline, you don't see $1 you make as $1, you see it as 70 cents. And you just commit. It's like when you get a pay rise, put it away. Because you were surviving yesterday and you will probably survive tomorrow. But if you spend it, you will never claw it back.
I love that. That's fair. One of the things I used to tell some of the young sailors when I was in the Navy, when I was still active duty, and I would tell them the same thing. I would say, listen, when you get a promotion or when you get a pay raise, for us, it was like every 2 years, you would get a nice little bump based on your seniority and where you were at specifically in your pay grade. I would say, hey, take that extra money and invest it and put it away. Just forget you even got that. I was like, you could set up an allotment and make it go to another account. Then take that account and fully invest it. You can make it so that when your paycheck hits your bank account, it looks exactly the same as it did before you got that pay raise. And you take that little bit extra and you just invest it. So I was like, you won't even know the difference. Or just let it sit there, and every 6 months or every 3 months, go check it and say, oh, look at the money I got here, and go invest it. Right?
Mike, if those guys and gals took your advice right there, you will have changed their lives.
I know a couple that did it, and I'm talking about this is 10 plus years ago, and they are in a very good place right now. And I know others that didn't. And it is what it is. This was something I used to do myself. When I would get promoted or I would get a pay raise, I would take that extra money and I would put it away. It's one of the ways I was able to actually get out of debt. And when I moved to Hawaii, I was able to buy a house out here. It's an easier way to do it. And especially for those that are not as disciplined.
Don't try to back winners with what you do put away. We didn't talk about this, but it's the concept of investing versus speculating. There's lots of people that are punting and speculating out there who think they're investors and they're not. And speculation is trying to pick a winner all the time. I'm going to back a winner. I'm going to back a winner. Investing is maintaining a diverse range of good quality assets over time. Now, it may not deliver your 20% return, but at least it's still going to be there. And through the journey, will actually achieve your goals.
I love it. All right, Tim. So we're at the point for the final question of the final round, right? Remember I said there was 4 questions. This one's a little bit different.
You did say 4. I'm getting nervous again
this
now,
one's
Mike.
a little bit different than the
I
rest.
thought I'd distracted you there for a moment.
You didn't get me off of it, but this one's not bad at all. This is just a personal question for you, especially with some of the information that you've been passing. I'm pretty sure that you've got a lot of knowledge from reading and listening and doing other things. You've been able to really educate yourself. So with that said, do you have a favorite business, investing, or real estate related book or podcast or both?
Gee, that's one of the things I get blessed with, and it's not something I can share. Everybody who I assist, work with, talk to, they feel that I'm educating them when it's actually going the other way. So as you talk to people, if everyone's got a story to tell you, and I find that has been some of the most powerful drivers of some of the statements I'd make today. Yes, I do read. There's a range of things that I like to look at that sort of lift you out of the misconceptions that we have. Ryan Gosling wrote a great book, which was really about the fact of it looked back to 1960 and compared where we are today versus then. Things were better in my day and all that sort of stuff. And he had example after example of how much better our lives are today, because I was born in 1960, so it probably resonated with me a lot. But it really struck me how far we have come and how far that we will probably go despite what we see in the news headlines today. And our ability as a human race to keep, if you went back and I just want you to imagine for a moment, you were a newborn babe and the year is 1900. And I sit you on my knee, but what's unique about you is that you can understand everything I say. And I explain to you the life that lies ahead for you. I explain what we're going to do during the First World War. I explain what's going to happen when we get back and the fever actually kills 3 times as many as the war did. I explain to you about the Great Depression. I explain to you about you'd almost say, can you just put me back, please?
Yeah.
Yet all of those.
So you're going to terrify that baby.
Correct. Yet all of those things happened. And today's people's lives are better than they were. They're not perfect, but they're better than they were, which gives fundamentally that goes back into that belief. Do I believe in the economic future of what we do together? Yeah, I do. Because we as human beings, our ability to overcome our own stupidity is truly astounding.
Yeah.
And so it gives me a lot of confidence.
I love that explanation and I love to that final question, but I do have one more question I want to ask you. So the final round's over, but this question is probably the most important question of the entire podcast because as we've been talking, you share your story, you share what you do, you shared some great ways for people to figure out those questions that they need to ask themselves to figure out where they are now and figure out how to get to what that destination is going to be. And I'm sure there are people listening right now that probably want to know more about you and maybe they might want to reach out. Can you share, or where can people find more information about you? Can you share like a website, any social media profiles people can follow and check you out?
Sure. They can certainly pick me up on LinkedIn, but probably, especially, I enjoy public speaking and I do quite a lot of that here in the country. And I will do more of that going forward because I think there is a story to be shared here. The website, timtownsend.com.au, will actually take you directly to a bit more background about myself, different podcasts that I've been involved in and so forth. And we'll also give people an opportunity if they need to reach out and make contact. That's timtownsend.com.au.
Awesome. Thank you for that. And for the listeners, you all know the drill. If you're driving right now, don't try to go to the website. It'll be in the show notes and you can copy and paste it or click away when you're in a safe place or you're back home. Tim, this has been fantastic. I want to say thank you so much for taking the time out of your day to join me and our guests and share your story and really give us some great knowledge and insight, especially over the vast time that you've been doing this. I think it's going to be very helpful to some of the people listening to this show today. So thank you so much.
Mike, appreciate you. Appreciate what you're doing for people with this type of sharing. Thanks very much for inviting me on.
Absolutely, 100%. I also want to thank some very special people out there. I want to thank all of you listeners. I want to thank you all so much for joining me and our special guest, Tim Townsend, on the Average Joe Finances podcast. Go leave us a 5-star review and tell us what you liked about today's specific episode with Tim. Aloha from Hawaii and have a great rest of your day.